Welcome, everybody, to this week's episode of Main Street Business Podcast with yours truly, Mark Kohler, and the amazing co-host, Matt Sorensen. Did you like that? Did you notice that inflection? Did you say that?
Matt Sorensen.
What?
Seemed very down, you know?
That was not. Corey, did that sound negative towards Matt? I thought it was. I came down on a bummer. Okay, let me try again. Welcome, everybody, to this week's episode of the Main Street Business Podcast with yours truly, Mark Kohler, and the amazing Matt Sorensen.
Yay!
Is that better? Okay, all right.
Yeah, so
okay, everybody. Now, I want you to know, everybody, that was included in the main recording. That was not a blooper. I did not ask Corey to cut. I wanted all of you to experience my versatility as a podcaster, that I could do that.
Much like maybe some progressive lenses in your fancy new eyeglasses. They're versatile.
Wow. Hitting hard today. Okay.
Mark just got back from Costco and got his new lenses.
Yeah, I've got these new Coke bottles, and I would not, first of all, I do not buy my glasses at Costco. No offense to any of you that do. These are very trendy.
But wherever you went, did you get an ARP discount?
Oh, wow. Okay, that's where we're going today. Okay, Corey, can you do something to Matt's image that makes him look pastier white than he already is? Can you do that? Okay. All right. Okay, well, everybody, welcome. This is an opportunity to learn tax and legal strategies in a fun and interesting format. Business, marketing, management, we cover it all. We want Main Street business to just flourish. That's what we're all about.
Yeah, and today's episode is our open forum. So this is the people show. You know, it's where we answer your questions. A lot of times you don't like what Mark and I want to talk about, and so we do this show. So we talk about what you want to talk about. And that's what we do. And if you don't like what we're talking about, well, make a difference. You could get to mainstreetbusiness.com and submit a question, and we'll talk about that.
I love it. Okay. Well, all right. So let's get into it. We got a lot of questions and no more dilly-dallying. Something my mom would say, who is an AARP member.
Okay.
Not myself. Not myself. Just want to point that out. Okay.
Yeah, you're just a prospect for AARP.
You're just jealous that I can go to Denny's at 4:00 and get their early bird, and you can't. I mean, that's really what it comes to.
Discount on your movie tickets? That's just not right.
Wow. Ouch. Okay. All right. Okay. Man, it hurts. All right. Okay. This question is from Eric. Eric says, "You guys rock. Keep up the great work." I always like to read that part of people's questions because
that's the best part of this question.
Yeah. I don't skip over that stuff. I began investing in startups in 2021. Well, that's fairly recent, but okay. So some via my self-directed Roth IRA, 10 investments so far. Okay, cool. And Eric, I know you, Eric. You were, oh my gosh, this is a great question because Eric was on my live webinar last night. Some of you may not know I do a live in-person, I should say very personable live webinar every month for those that want to get involved. It's at markjkohler.com where I do Q&A on a specific topic. And Eric asked this question last night, but I thought it was a good one. So we're gonna cover this for everybody. He says, "Some I've done with my personal trust, 12 investments. Some I've done with my Roth IRA, 10 investments." So, man, he's no holds bar. He's in 22 startups now. He was watching Shark Tank, I guess. Jeez.
I guess so. You know?
Wow.
He wants to, he's this little Mark Cuban right here. Mr. Wonderful. He's just
spreading the wealth, baby. I love it, Eric. Okay. He says, "Now that I am receiving numerous K1s," okay, this is the backside of startups as you're like, oh, I've got paperwork coming my way. Yes. So when you invest, everybody, so you know what we're talking about here, when you invest or partner in an LLC with someone, you're going to get what's called a K1. It's like a W-2 that employees receive. A K1 is what members of an LLC or partners in a partnership get. A K1 kind of says, this is your gain, this is your loss, this is what you got, and then you got to go put that on your 1040 tax return. So if Eric invests in 22 companies, he's going to get 22 freaking K1s. He's not too excited. He says, these would be passed along to our accountant. I'm wondering if it would make sense to use a single member LLC owned by our trust for all of the non-IRA investments. to simplify tax reporting that I give the CPA the LLC info rather than a dozen K1s. Okay, I want to comment on that part, Matt, but I got a better question that I think Eric could have posed. What do you think? Is there an asset protection angle on this? Like having a COPE entity maybe own all of these little startups? What's your take on maybe an asset protection angle? And I'll maybe hit the accountant angle.
I mean, I presume Eric has some pretty significant assets in general. I would just, if you've made 22 startup investments in a year, I'm just making a presumption you have a lot of assets. So I think a COPE entity would be a good thing to consider for asset protection alone, because one of those 12 startups that you own personally, if it's just owned in your trust right now, trust is not asset protection. If this is just a revocable living trust, there's sometimes some privacy benefits to it, but it's not asset protection. If you get, a judgment against you for something, you're texting and driving, default on a line of credit, have a real estate deal gone bad, you personally guaranteed, a business go bad, you had a personal guarantee on, whatever it may be, they're chasing you down and they can get at your other assets. So a charging order protection entity could make sense where you have one LLC that is basically your holding company that would own these 12 assets. You generally look at Wyoming. One of the consults with one of our attorneys, we could look at that. Yeah. So that could see a little asset protection angle to this. Not automatic. You wouldn't have to. And we don't need you. You have asset protection, of course, everyone from all those startups. They should have their own corporation or LLC that's giving you liability protection as just a shareholder investor. But to protect those assets and those investments, one of those 12s might be the next Uber. Who knows? Yeah. It might be worth millions. Hopefully it is, Eric. But, that could be at risk if you had some personal liability somewhere else.
Yeah. And what Matt just rattled off there at the last moment, I'll give an example. Let's say you were texting and driving and got in a terrible accident and someone sued you, and come to find out one of your startups is worth $1 million. They're going to want to go after your ownership in that. And having an additional entity, which we call a COPE, charging order protection entity, in between that could be a nice fit. Now, that's the topic we covered last night in the live webinar. Any of you that want to access that, you can watch the last 12 months recordings of the webinar over at my website, markjkohler.com, and that's what we covered. But okay, now here's the accounting take. Eric is saying, I'm getting these 12K1s. I don't want to give them to my accountant that's prepping my 1040. They're going to charge me more, or it's a headache. So why don't I set up an LLC, maybe get this asset protection perk Matt mentioned, and I'll have all the K1s go there and then file that LLC tax return and kick out one K1 to my individual accountant. Well, Eric, someone's going to have to deal with those 12 K1s.
Right. It's either on it's coming on one return somewhere.
Yeah. You're getting it on one angle or another. There's probably some good metaphor here I could use. You're going to get smacked around one way or the other. But so it is. So if you set up an LLC just to avoid 12K1s, they're going to get reported on that tax return. Some accountant's going to have to deal with it and then give you one. I will say this, there is one other benefit besides asset protection of doing a COPE LLC to collect all these K1s, and that is audit protection. The more K1s and think of it this way, the thicker your 1040 tax return is, the more likely it's going to get audited. So if you have a holding company for all these 12 startups and kick out one K1 to your 1040 is going to be clean. I learned this from a client, almost 15 years ago, multi-million-dollar client, and and he was so proud that he and his wife's tax return, their 1040, was like 4 pages long. He was like, I keep this thing tight. But he had all these other business interests going into companies, but they just give us simple K1 or maybe a W-2 to him. And so his 1040 was really clean. And since 1040s are the most often audited, I think keeping all those K1s off might be nice there. Just another thought.
I think that's a good idea. Now, Eric would, probably need to be, maybe if you're married, do a partnership with your spouse, so you could do a partnership return, actually. Because otherwise you're going to need a way to get a return where you're filing a return for the LLC. Otherwise they're single member if it's just you. Where you have your trust too, that's another thing. We love the trust in there because it's single member. So it's kind of a weird situation to elect into partnership or a way you'd get a return, because we do like the trust being the single member. But there's ways you could do it. You could list yourself as a 1% owner and your trust is 99%, or there's other strategies to do it if that was super important in your situation.
Okay. Let's jump over, Matt, to, why don't you read Ryan? Do you want to go up to Ryan's question? Just kind of take these.
Yep.
By the way, everybody, if you have a question, we are not taking these questions live today. Sometimes we do. The best way to submit a question is at mainstreetbusiness.com, mainstreetbusinesspodcast.com or mainstreetbusiness.com, and just submit a question. And when we do our open forum, we grab from there. If you like a question of someone else's, heart it, because those questions get a little more priority. And it appears someone hearted Ryan's.
We got some of Ann's up here, and Thomas's have gotten hearts. We'll get to those guys. So let's hit Ryan's though. Ryan says, Mark and Matt, thanks for setting me straight on the last podcast. I needed that. Okay, I think this was about, restructuring your business maybe, or, maybe you did your LLC wrong. I don't know. But he says, now that you've knocked some sense in me, I'm thinking I need to restructure my business entity. What pitfalls do I need to be aware of when shifting my electrical contracting business into its own LLC? Should I make the S election for it? I'm waiting for the books to get here so I can hopefully find the answers and many more on my own. Until then, I'll throw them up here, partly to hear them on the podcast and partly because I like hearing other people's questions and figured I'd share.
Matt, okay. As you start to talk, Corey, am I able to share my iPad whiteboard?
Ryan, what I would do, an electrical contracting business, I would separate into its own entity. I don't know what you may have mixed in there. Maybe it's real estate. I don't know, but it didn't indicate that. But electrical contracting could be a liability inducing business, right? I did just watch the new Spider-Man. I didn't know that was it Jamie Foxx was a villain, an electrical villain? What was that?
Yeah.
Have you seen that?
Oh, and Andy Garfield, what?
Andrew Garfield's in it too, but
yeah. Okay. Well,
anyways, but things can happen in electrical contracting businesses. And so you have liability there. And so we want to keep that operational business separate from any assets you may have. That's a fundamental when we're doing structuring. So, but that could be in its own LLC or it could be in an S corporation. Now your question was, should I make an S election for it? If you're making 40 to 50,000 net, this is after all your expenses in this electrical contracting business, absolutely. Add an S election to that LLC, have it in its separate entity, and don't add assets to it.
Okay, so Matt, let me add a little whiteboard to Ryan's question. So everybody, we love the trifecta. And this is a perfect question, Ryan, where you might want to set up a 1-hour consult with one of the attorneys and have them build out your trifecta for the year with some action items. Very affordable. Okay, and save you thousands. Okay, so everybody watch what we would do for Ryan here. So we've got his trust down at the bottom. I'm going to actually give two options here, because what Matt said was electrical contracting should have its own LLC. Well, the hard part, and this is why a consult is so helpful, we don't know what else is going on in Ryan's life. How many other entities does he have? Is he married? Or what state
I made an assumption that he had real estate in there and assets. So that's what I had to go with.
Oh, okay.
All right. Sometimes you have to kind of make up the rest of the facts to fully answer the question.
Yeah, so Matt likes to make up facts when he answers questions. That's not how I roll.
It's called creativity.
Okay. It's called jacking people up.
For those that are watching, ingenuity. Okay.
For those that have the pleasure
outside the box thinking. Okay.
For those that have the pleasure of watching this on YouTube, you get the benefit of our little quotation fingers as we say each one of those. Okay. All right. Well, I would throw this out, Ryan. Having multiple S corporations in a client's life is something we try to mitigate. We would like to have a scenario where you have one S corp. Now, if you have multiple business operations, you might have the electrical as a subsidiary. So it's out there, like Matt said, it's got its own little liability shield, its own merchant account, its own bank account, may have its own employees, because your parent S corp might be doing some other things online or have some other operations or other income, or maybe your spouse has some income. So there is a possibility here of having an LLC parent own the electrical business up here and separate the liability of that operation, but have it all flow into one parent S corporation, where you might have a W-2, your spouse might have a W-2, and so I'm not gonna say any more. Matt's comment was actually right on. What I try to do is compliment my co-host, unlike others.
Yeah.
But so I think Matt's comment was excellent. But if you're able to watch this on YouTube, I think that's a possibility here of having this subsidiary scenario rather than just one main entity.
Yeah.
Okay. All right.
Love
Matt,
it.
so a lot of people like Ann's question here. Wow. Lots of hearts there.
Yeah. All right. I'll give it a read.
Okay.
It says, hi, Mark and Matt. You've said to put my vehicle in my LLC instead of my name. We'll come back to that. It's currently in my name, and I use mileage across different LLCs plus personal. Which LLC should I put my vehicle in? Operating, Oregon. Passive, Michigan. Wyoming, or it in or out of state. Real estate or non-real estate are options for me. Working
oh
with
my gosh, that was a mouthful. You're going to have to, can you put that in English? I got a little lost there. Okay.
I don't know. That was a tough one. And man, you killed me on that last sentence there. Basically what Ann's trying to know is, do I need to put my vehicle in an LLC? Now she's saying we said this. I don't know who said this. I don't know if Mark said this, but maybe an RV, but I don't think your regular vehicle.
Hey, I'll come to Ann's defense. I have talked about putting vehicles in your business entity when possible. But the only correction I would say is, everybody, we're not telling you just across the board, put your vehicles in your entity, but it can work. But
yeah.
Matt, what do you, I'll draw while you talk.
Okay. Let me just make a couple points first here. And how you're expensing this, and this is the issue, one of the issues is we don't need the vehicle in an entity for you to take the mileage and take expenses on the vehicle. So if you're using that vehicle for business use, whether this is to go to a rental property or in your operational business, use that mileage for each respective activity. Totally fine. And that's going to be expense against the rental property. It's going to be expense on the operational business. But you don't need to put it in an entity for tax purposes. So just know, for tax purposes, doesn't matter one way or the other. Now, would you want it for asset protection? I'll let Mark throw this fastball at Mark.
All right, we're going to use the trifecta. And I know, people, please know, we're not making a shameless plug every time to this trifecta, but it's simply because a picture says 1,000 words. It really does. It helps so much. Whenever a client is on a phone call with us, with any of our attorneys, we have trained all of our attorneys to get PowerPoint open, get on Zoom if possible, and start showing what you're talking about, because it just makes so much more sense. So if you're able to watch this again today on YouTube, what we've got here is Ann's situation on the left. She says she has an operating entity in Oregon. And then over on the right side, she has an LLC in MI. Is that Michigan? I'm embarrassed.
Yeah, Michigan.
Okay.
Right.
There's a lot of, it could be Mississippi's MS, I guess.
That's MS, yeah.
Okay. Missouri?
Minnesota's MO is Missouri.
Okay. Gosh, man, you're just a little encyclopedia today, aren't you?
You know, I know the 50 states.
Okay. Wow, man, this is going nowhere good today. Okay, all right, now.
What podcast are you guys listening to right now? I don't know, but you're listening.
Yep. All right. So if we're looking at this, on the left side, we have an LLC in Oregon. Then on the right side, we have an LLC in Michigan with, let's say, a couple rentals. And she says, where am I putting my vehicle? So Matt's first point is right on again. You can write off the vehicle in pieces and parts on both sides of the transaction. You could write off mileage on the operation side. You could write off mileage on the passive side. If you're going to actually depreciate the vehicle and take actual, you're going to have to choose which side of the equation you're going to put this vehicle. Typically, we're going to write it off on the operations side when you're out visiting clients and customers and picking up supplies and blah, 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 blah. Well, but again, if you have a lot of rental properties, you may say, well, I use this truck to maintain all my rentals. And so you might write off the truck over on the rental side. So again, more facts in a consultation help out a lot. But here's the thing. Where do you actually put the title of the vehicle? See, the IRS doesn't care where the title is. This is more of an asset protection thing. Well, heaven forbid you put a vehicle in the title of your LLC, on title to your LLC, where you've got your rentals. I mean, heaven forbid there's an accident and they're going to sue the driver and go after anything the owner of the vehicle has, which is your rental. So I'm going to put a big X through that. We do not want the vehicle on that side. And if I had to choose between an operational entity and personally, now this is generally going to be with a vehicle that's paid for. If you've got a lien against the vehicle, you're not going to have much choice. But if this vehicle's paid for, think about it. Should I put that vehicle in Ann's name, or should I put it up here in this LLC/S Corp that is simply a shell? Remember, a shell entity should be running your operations. And I would tend to lean on having the business vehicle in the operational entity for asset protection, if that made sense when we had all the facts in Ann's scenario. But that would be preferable over Ann owning it personally. Because if she's driving this car that she owns personally and gets into a crappy accident, they're going to sue her and try to go after all of her personal assets, yada, yada, yada. Where if we have just this shell LLC/S Corp owning the car and there's an accident, we're hopefully going to be able to get some sort of barrier and protection between the entity and Ann's personal assets. So,
yeah. Let me say, of course, for those of you business owners that have employees, where you have equipment, you have trucks that are going out on job sites or delivery or whatever it may be, those are definitely in the operating entity over there, that on the left side. All right. That you got employees driving that stuff, that's definitely over in the business operating entity. But it's kind of this quasi, we're presuming this is a personal auto. Where does it go? This is where the quandary happens. So hopefully that was helpful, Ann. Now, Ann has another question, by the way, which is also a pretty good one. She got 5 hearts on the next one, too.
Oh, wow. She's got a lot. Hopefully she's
it's
not
about the
hearting
IRA
her own
LLC.
questions here.
Can you even do that? I don't
know. Maybe probably not. No. Okay. So what's her next question here?
All right. She says, you mentioned putting an LLC between the self-directed IRA and the investment in the self-directed IRA in order to eliminate interacting and paying the IRA custodian every time we do something where it might be required. Is there an optimal state to put the IRA LLC? I live in Oregon. Again, we know, Ann, from your last question.
Yeah.
And you have LLCs in Oregon and operating in Michigan, Pennsylvania, and Wyoming. Okay. All right. So, man, Ann's getting a full consult here today.
Yeah.
So, great questions, Ann. Seriously. So, let me hit this one. So, your IRA LLC. So, you have your IRA, and it can own assets directly. Of course, we have our company directed IRA, and hopefully you're using them. Where you can set up the self-directed IRA. But that IRA can own an investment property directly. It can make a note. It could invest in crypto, invest in a startup like Eric's earlier that we talked about. So, but a lot of clients, particularly the real estate clients and some crypto DeFi clients, will use an LLC where the IRA owns the LLC 100%. The LLC in turn goes out and makes the investment. And so now let's say it's a rental property. Your IRA invests in the LLC in turn goes and buys the rental. You're manager of the LLC and controlling everything in the investment through the LLC, which has a bank account and everything. We have a lot of prior podcast episodes, the Directed IRA podcast. Mark and I both have videos on this. There's a whole page of how the IRA LLC works, 2 chapters in my book, lots of content on this. But to your specific question, Ann, what state?
Yeah, you can answer a question. You want me? I can jump in and answer a question.
I was getting there. I mean, you were doodling a lot on the last one, so I figured I'd,
Okay, take a few laps.
The speaker recognized me for, 5 minutes, and I want to take my 5 minutes.
Okay, all right. All right.
So, all right. So, Ann, this is an easy one. we're going to set up the LLC in the state you're buying assets. If you're buying real estate, we're going to set the LLC up in the state that IRA LLC is buying real estate. So if it's Oregon, it's going to be Oregon. If you're buying Michigan properties, we're going to do Michigan. If you buy Michigan properties and then you buy Pennsylvania, we'll set up in Michigan and register it foreign into Pennsylvania. So always look at where you're buying. Now, sometimes you might be doing something like that it's not a property, let's say. Maybe you're doing lending, or you're using it as a holding company for some crypto stuff or startup investments, which in that case, you could just do Oregon, the state you're in. But otherwise, we're going to look at the state you're buying assets or property. I'll yield back the balance of my time.
Okay, well, great, great comment. And I would just say this, folks, if you're able to see this in the diagram, this section here where the IRA is the owner of the LLC, notice how that's juxtaposed. That for some of you, Matt, you may want to know that means different.
I'm going to have to look that up. Okay. Yeah, juxtaposed, different? Okay.
Yeah, it's different from the alternative. So juxtaposed or compared to this over here, this LLC is owned 100%
compared
by
to or different. I don't know.
Hey, will you roll with this, damn it? Okay. Work with me. Work with me. Okay. All right. I'm trying to use, new words all the time, working on my thesaurus internally here. Okay. Now, notice everybody, this LLC is owned, this Wright LLC that she has in Michigan on the right-hand side is owned 100% by her trust. This LLC is owned 100% by her IRA. It could also be owned by multiple IRAs, brother, sister, mom, dad, husband, wife. They could have kids all in this LLC to create a multi-member LLC. One thing she alluded to in her question was it makes transactions easier to do the LLC. And I do want to echo that comment. That makes sense, because as you're collecting rent, paying bills, you get to be the manager of this LLC, Anna, and that's totally, or Ann, sorry, that is totally allowed. It's valid to do so, to be the manager of the LLC. You can't pay yourself. We have a podcast on prohibited transactions, but don't listen to any custodian out there, people, that says Ann can't be the manager of the LLC. She can easily pay bills, do the bookkeeping, hold this thing together, and not have to call Directed IRA or any of these other trust companies every day with transactional requests. So you're getting some asset protection. You're able to pool your money. You're also able to expedite transactions and make life easier. So this LLC owned 100% by the IRA, and your beneficiary to the IRA would more than likely be your trust. So this is how it all flows downhill into your trust. Just beautiful. Work of art, if I may say so. Boom.
Love it. And you should sign that and sell it. They should make an NFT of that picture.
Boom.
Right there.
That's the NFT right there.
That's nice.
I should. Okay.
All right. Thomas has a question about owning property foreign, not in the U.S., but using a living trust in the U.S. How does that work? How should I title my foreign real estate? Okay. Now, in the U.S., we have a set of laws. That we have a constitution. The states have to recognize other states' laws. So if you have a trust set up under the laws of one state, other states have to recognize it if you have assets in those states. We also have a federal income tax system that all of our estate planning and trusts are designed around and are contemplating and are taking into account. Now, it is not taking into account foreign jurisdictions. Once you start owning property in a foreign country, your estate plan is flipped upside down. It's going to work in the U.S. for assets in the U.S., but assets in a foreign country, you're going to need to go get foreign counsel. You're going to have a foreign probate system that you're going to have to deal with, and you're going to need to go get foreign legal counsel for that, unfortunately. And Thomas, I know that seems like a simple question, but it's a complicated answer.
Yeah. And I think the best approach to take in this situation is you've probably got about 187 countries that you are going to have different rules for. And you're just going to have to look at what does that country provide as a way of ownership for that asset. And hopefully you can make the owner of that structure or trust in Austria, or I think in Mexico that has specific corporate laws that are really specific to Mexico. You can't go down there with a U.S. trust or a U.S. corporation. You've got to set up a corporation in Mexico, but then you make the shareholder of that corporation or the beneficiary of that trust in Austria or whatever the structure might be in Ireland or Australia or wherever it is. Try to get your trust in as the owner of that entity or the beneficiary of that trust in that country. So deal with their structure first, but try to make your U.S. trust the owner or beneficiary of that. Would you concur, my co-host?
Yeah, sometimes possible, sometimes not. That's why it's like, there's 187 different answers. And really, you need a lawyer who understands Austria law, the law in Austria, and has a little bit of understanding of the U.S. And this is why there's international law firms out there that charge an arm and a leg, because this is a tricky area. So, but I do like the idea, and I've done this with clients. They'll have their trust own a U.S.-based LLC, and in a lot of countries, that U.S.-based LLC owns a foreign entity. And in that way, they're protected. They have a company. Companies don't die, but the underlying ownership of that can pass through the trust, and that structure can work. Thomas was asking here in terms of a personal asset, not a rental property. But you could still use the LLC structure and entity structure where the underlying ownership is eventually a U.S. LLC and a trust that owns the U.S. LLC. That can sometimes be an easy solution. But again, not always certain it's going to work in the foreign country where you're looking at. Plus, you're going to have issues of who's the officer in that country, what happens in changing that when you pass away. You got to think of some logistics there too.
Yeah. And for those of you that enjoy my artwork here, I can come play Pictionary on your team at any point and hopefully add to the experience. Right here, we have our trifecta, and this is our asset side. And over here is our operations side. And so those, again, that are new to this trifecta diagram, this really just kind of puts it in context from a visual standpoint. You might have your little LLC side hustle here. You might have an S corporation. You can even have a little sole proprietorship, and maybe your day job is over here. But this is all flowing down to your US 1040. And I like to show here that you might have an IRA that your trust is the beneficiary of, your LLC in Arizona that your trust is the member of or owner. And then here's this LLC in Austria or a trust in Austria where, again, your trust is hopefully the owner, or as Matt said, maybe a U.S. LLC provides a little buffer as an owner in the in-between area here. And this is where it all, again, flows downhill into your 1040. And from a tax perspective, remember that as a U.S. citizen, you're taxed on your worldwide income. And so whatever you're doing over in Austria or whatever country you're owning that real estate, you're going to have to report your taxes in that country, whatever their rules are. And if you pay any tax in that country, you're going to get what's called a foreign tax credit on your 1040 in the United States, typically. Now, again, there's U.S. treaties, and a lot of different countries can put a twist on this. Even NAFTA between Mexico and Canada and the U.S. can get tricky, but hopefully you're enjoying your trip to Austria, Thomas. I think this is a lot of fun. So
yeah,
get out there, go at it. So
isn't that where what's the musical in Austria?
Oh, dude, The Sound of Music.
The Sound of Music.
Yeah,
Sound of Music. Yeah. That's all I think of Austria. And isn't Arnold Schwarzenegger from Austria?
Yes, and Hitler's Eagle's Nest was in Austria.
Okay.
Yeah,
I'm gonna reference Sound of Music and Schwarzenegger.
Fair enough.
And Hitler's lair.
Yeah, Hitler's lair was over there, but no, yeah. So
fun fact.
Yeah. So the cool part here, from a tax perspective, too, is that as you're taking trips to Austria to go check on your rental property, you're going to make those tax deductible expenses, hopefully not only under Austrian law, but U.S. law as well, because that is a business. You have a business in Austria. And so that's going to be a valid write-off and really a nice little perk. Well, great question, Thomas.
Yeah. Tim has a good question. Okay. Tim from Texas. He got 2 hearts on it.
Ooh, okay.
He says, by the way, he got his calendar this week.
Oh, okay.
I don't know if the MJJ calendars are out, but are they all out?
Yeah, let's do a little shameless plug here. I carry my calendar around with me everywhere, the MJK monthly planner.
Mine's on my desk over there. I just can't reach it.
Okay. Oh, thank you. I appreciate that, Mr. Matt Sorensen. we've got tax deadlines and little charts and tables and maps of the United States with different tax and asset protection strategies. And every month of the year, your 10-year plan is a spot for that. So everybody, we will sell out by the end of the month. So get to markjkohler.com, and it's, I think, $30, and it'll save you thousands with your attentiveness to the tax strategies and the tax deadlines you should be aware of. So, all right, Tim in Texas, what does he got, Matt?
All right, he says, can you discuss the tax and legal asset protection implications of getting married?
Oof.
Woo. Okay.
I'm not. We're going to touch that one, huh? All right. Okay.
All right. You got 1 minute. Now he's got some specifics
here. Okay, so we're going to go to the 3-day seminar on this.
Yeah.
Okay.
Yeah. We're going to add some facts here, and these are Tim's facts. Okay. He says, specifically, my soon-to-be wife and I are both doctors, and it seems like we will get penalized for getting married. That is true. I'm going to come back to that. There's a marriage penalty on taxes for high-income earners. It's total BS. That's true. We'll come back to it. Second says, would a prenuptial agreement protect us in some way from a liability lawsuit? And finally, Tim, you're going for 3 here. Finally, if we get divorced, does the common law versus community property law apply based on the state of marriage or the state of divorce? Woo! All right. Well, we can work. I don't know if you want to work forward or backwards on that one, but
what I would throw, I really think we've got to be careful here, because this, you know what, I'm going to propose this, and this could be dedicated to Tim. Why don't we cover in one of the next upcoming podcasts this very question: tax and legal considerations when getting married? Because these 3 questions could easily absorb 10 to 20 minutes just trying to give them a good answer, and there's probably several other things to consider. What do you think, Matt? We bumped Tim to his own podcast dedicated to Tim next week or the week after.
Yeah, I'm going to give a short answer, though. I'll give the Reader's Digest version.
Okay, go ahead.
I mean, I don't want to leave Tim hanging, plus I want to,
all right. Give
a little
one
tease for this next episode.
Okay. Yes. There's a teaser for our podcast coming up. Okay.
I did not believe this, and I was proved wrong on this. There is a marriage penalty for high-income earners. If you are single and you're a high-income earner, you marry another high-income earner, you're going to pay more in taxes than you would if you stayed single. It just is what it is. Write your congressman or senator. Nobody cares. You're both high-income earners. They're like, bless you. You could at least cut your living expenses and live together, I guess. I don't know. So yes, that's true. Yes, a prenuptial agreement could protect you from a liability lawsuit to separate your assets. If one of you had a lawsuit, the other didn't, and you had your assets held separately, I could see some legitimacy to that. And then common law versus community property is usually going to be on the state of divorce, because you may move around from where you get married, but essentially in some state you establish residency. That might be usually going to be on the state of divorce, but you would have had to both establish residency for that to change. So love the question though, Tim. Okay, it's going to get an episode, it sounds like.
Okay, we'll give it an episode here. Okay, great question from Tracy today on the show. Are crypto rewards that I get on Voyager taxable? Even if I haven't sold any crypto yet, what if I'm even at a net loss in my crypto investing? Well, Tracy, you're at the right spot. We are holding our next Crypto Tax Summit in Miami on May 19th and 20th, a 2-day event, which the last one sold out for the in-person attendees in Phoenix. We're going to be doing networking lunches, a networking breakfast. We have a VIP all access experience and preferred seating if you want. It's going to be a lot of fun. And then for all of you that can't attend in person, you can get the virtual broadcast, and all of that is available at cryptotaxsummit.com. But let's answer this question, which is actually a section in that 2-day event that would probably take up almost 30 minutes or more. So we'll try to answer this as easily as possible here, Matt. So why don't you, rewards. I hate this word. This is kind of the crypto industry's way of saying, oh, you get a reward. Like somehow it's caged in a way.
like points from your credit card. They want it to be like that.
Yeah,
Not
yeah.
taxed.
You're not going to get taxed on this. We're just going to call it rewards. Well, Tracy, should I give her the bad news or do you want to? I don't want to be the bad guy. You want to be the bad guy?
You're like, this is a great question, Tracy. Oh, we got our crypto
screwed.
tax summit. Matt, give her the bad news. All right, Tracy, here's the bad news.
Quite well, yeah.
Here's the bad news, Tracy. I mean, I saw that one a mile away, by the way.
No, it's not coming. Yeah.
All right, it's like you can kind of through the material. They're like, all right, now it's Matt's turn to talk. Okay, Tracy, I'm sorry. Yes, your rewards here is an income to you, so that's going to be taxable, even if you've just bought crypto through Voyager that has gone down in value, because you haven't sold that crypto yet, so you haven't locked in the loss. Yeah. So, but works the same way. If your crypto is going up in value, you're not paying gain until you sell either. So it does work both ways. Don't feel like you're getting a raw deal here. So, but yes, you are taxed on the rewards, yield, earn, whatever it may be called, on what platform you're on.
And
that's at the fair market value of whatever that is worth.
Yeah. I'm going to try to highlight this with our trifecta, for example, because believe it or not, when Tracy says rewards, she's generally talking about staking. And staking can be taxed in 3 different ways, or there's really 3 types of staking. On one extreme, if Tracy was to go out and buy her own nodes and be a validator and manage her own staking operation, that's a business. And so over here, we would recommend on the left-hand side of your trifecta and operations, you're going to use an S corporation generally. Again, we don't know Tracy's complete financial picture, but she's going to pay self-employment tax on staking where she's actively involved in the process. Now, when she says, well, I'm using the Voyager staking reward platform, well, that's going to be very passive. So over here, you have a staking scenario where this passive involvement is still income, but it's going to be reported on a 1099 miss, where it's miscellaneous income or other income that is not business income, so you can't take write-offs against it. It's just this quote-unquote reward that accountants are referring to it as other income. But I have to distinguish this between, and here in the diagram, you can see this. You've got, I'm going to put this in red, you've got your capital gains from your coins. I use the emblem of Bitcoin here. So you've got growth that would only be taxable through long-term or short-term capital gains, or you may have losses if it goes down. If you were to sell it, and we teach the strategy of wash sales, and cryptocurrency traders can use the wash sale and capture a loss and rebuy it the same day. Stock traders cannot do that. But see, everybody, on this side of the equation, she's dealing with this capital gain scenario. But when she's staking, that is a different revenue source. That is other income. And so that is going to be taxed, whether, even if she does take it and then hold, because she's typically going to be paid in tokens or crypto, and then that's going to sit over here and then have capital gain or loss in the future. But as you earn it, you're going to pay tax on that piece. Matt, thoughts? Is that kind of a helpful layout there? I hope visually.
Yeah, I love that. And we've had a lot of content in prior episodes on crypto tax, and the Crypto Tax Summit, you're going to get a deep dive in that. So make sure you're tuned into that. Tracy, you can watch it, stream it too. If you don't want to be in Miami for all the festivities and fun, you can stream it virtually too and have the convenience of that as well.
And I don't think I'm going to wrap this up with this point. I didn't think I closed the loop on this. If you're staking, actively engaged in the staking and node operator status, I'll put active staking, you're going to want to run that through the S Corp so you can create some savings on self-employment tax. So there's no self-employment tax on the pass-through income of an S Corp. You may or may not have to take a W-2. That's going to be very taxpayer dependent in the situation and what you're doing with the money. But if you don't, you're going to just pay self-employment tax on a Schedule C, which is ugly. So everybody out there, hopefully this little introduction here kind of wets your whistle or gets you excited for the Crypto Tax Summit. So hope to see you there.
Yeah.
All right. Final question today, Matt.
Okay. Ooh, there's two good ones here at the end. Let's go with Jeffrey's.
Okay.
Says, hey guys, love the show. I have an LLC residential rental property for liability protection. I have 100% equity in the property. You've said in the past that an LLC needs to have cash in its bank account in case it gets sued and goes before a judge to be considered a, quote, real business to assist with maintaining the corporate veil. So now I retain about 12 months of operating cash in the account. How many months of future operating capital should I maintain in my LLC? Of course, Jeffrey here wants it to be the minimum, as little as possible, to have a real business. Now, I think, Jeffrey, on this question, if you don't mind, Mark, you know, throwing my thoughts in first here. I'll let you clean it up. I would just worry about the operational cash. I don't even know that I would do 12 months.
No.
Especially if it's a rental property with current active income. I might do 3 to 6 months of operating capital in there. Because if it has a property in it that generates income, it's reasonable for that business to only have a few months of operating income. Now, would it be zeroed out every month? No, that's not reasonable either. But having some little bit of operational income for a few months of future expenses, I think would be reasonable and sufficient so that any plaintiff or creditor couldn't make the claim that this LLC was a sham because it held no cash or assets and therefore wasn't operational.
Yeah. I would add a little different analysis to this, or I think I'm going to pretty much say the same thing as Matt, but from an accountant's perspective, I'm going to be more precise instead of, general like Matt Sorensen. So I'm going to throw out here. I think Jeffrey gives me an important fact in this fact pattern, an important tidbit. He says there's no mortgage. When he said he has 100% equity in the property, that means there's no mortgage payment. So
yeah, great point.
So we've got to look at what are the operational costs for this property. So maybe utilities, if that, maybe your tenant's covering all the utilities, property tax.
Insurance.
Maybe there's some landscaping, insurance. Yeah. So I'm more worried about what are your operational costs, and some people call it the monthly nut. What do you got to pay for every month? And those costs per month, that's really what I'm worried about. I want to have a reserve for that. And so you could say, well, I want to have 3 to 4 months of operational costs in the bank just in case. I think any more than 3 or 4 months in this situation would be a little excessive. Now, Matt's perspective, I think, is a good one too, is saying, well, I want 2 to 3 months of rent in reserve, because if that tenant leaves me hanging, I want to make sure I've got 2 to 3 months of reserves of accrued rent to lean on while I go find a new tenant. Then there's a third perspective. So I'm going to put these in red here in our diagram. Number one was look at your costs per month and maybe do a 3x. You could look at your rental income per month and do maybe a 3x. Another perspective is, what type of repairs may I need to foresee in the future? Am I looking down the pipe at a new roof, a new furnace? Do a little audit once in a while if you're a rental and go, ooh, I'm going to have to throw down a new driveway here in the next couple of years, or a new this or a new that. And this is what HOAs do. They kind of look and forecast out, what are the reserves I need for a future improvement? And you could start saying, I'm going to start saving up for that now. And so a third strategy would be to create a reserve for future repairs or future improvements, and be thinking ahead. It's the clients of ours that are just living month to month on their rental income, not usually the best approach here, because you're going to have to do something maybe 3 or 4 years from now, and you're going to have to go dig up that money somewhere. And you go, oh, well, I'll refi the property, or I'll do this. You know what? You're now praying that the property continues to grow in value and all these wishful thoughts that you may have not lived through 2007 and 8. So think of maybe an improvement bank account and start setting aside a little money for that future rainy day expense. So just another thought.
Yeah. Okay.
All right.
Just another thought, he said, just a little spin on that. Just a little spin. 5 minutes later.
All right.
Thanks everybody for listening to this week's Open Forum podcast of the Main Street Business Podcast. We'll be back next week. We do this open forum. I think every 3 to 4 weeks we try to do open forum. So we skipped a couple questions and they were good. We just didn't have enough time. I'm so sorry. Ethan and Kurt, you guys both had great questions too. But we'll try to get to those on the next episode. For any of you that have questions you want to get in, of course, go to mainstreetbusiness.com, hit submit a question. We'll be back the next few weeks with another open forum episode.
Thanks, everyone. See you next week.